Hey guys, all right, it's Dave Russell here at TradeStation, VP of Market Intelligence, and hope everyone's doing well. Just going to show you these disclosures. So as usual, the way we're doing things now is go to TradeStation and go on the homepage. Just show you after this. Go to on the top nav, go to Research and then Insights. And we won't have to be sharing as much stuff because it's all going to be provided in a blog post that appears at the top of the Market Insights blog. It's going to have a Wall Street sign, and that's what we're going to use. Tell you this market has signs of some kind of fatigue here. All right, so if we're right here, and we want to go first of all to TradeStation, go to Research and Insights. And then this blog post has our talking points for today, including basically a new little indicator I gave you, which is called MA. Here it is. This is actually a chart I was doing. Let me do a little something here. Let me show you. Go to settings, go to window, and then we can go to status line, general. There's a way for me to show. Here we go, status line, show status line, and we want to add studies and strategies, and then hit OK. So it now tells us this is a thing here called MA streak chart, and that is included in the zip file that is right here. I'm going to get to that in a second, but it's another thing I've given you. I've given different forms of this before, so go ahead and check out this blog post, and we'll kind of work our way through it here. All right, so as we kind of get started, I want to mention something that's kind of interesting here. It looks like we had some kind of bad 30-year bond auction an hour ago. This is the 10-year. Now, this is TradingView. It just makes it a little bit easier for me to kind of jump around on this thing. TradingView, we have an outside relationship with them. People can join up their TradeStation accounts and Trader and TradingView. I mean, if you're using the platform, not really sure why you'd want to, but I kind of work with both because I write some of the trade ideas on TradingView. So I use that their charts sometimes. And in this case, this is a 10-year TNX, similar on TradeStation. It's $ TNX.X. It's the bond yield, and then let me just show you this. So this is a 10-year, but if we look at this on a really short-term, like 5-minute chart, look at this jump at 2 p.m. Eastern. The real news was on the 30-year, which is TYX. This had some kind of bad auction, but the one that I watch, and which I think is more actively used for charting purposes, is this, and it's important because we have this kind of, trend line coming down, and we have the support level at 340 that we have held here. So you kind of see here. So anyway, the point is we're not breaking under it. So let's just think about this for a second. The Fed now is pretty much saying another 25 basis points. So let's look here at the 2-year Treasury yield according to the Federal Reserve. So this basically is going to follow Fed funds. So what's interesting, if you look here in the most recent time period, as the Fed has basically, they're not pausing. They're not saying we're done. They're not like doing 75 a month, per meeting, but there's still some upside there. And we're seeing now, as we're seeing the 2-year yield start to follow that trajectory. So there's a relationship between the 2-year and the 10-year and the 30-year. And it's shown with this thing, this yield curve, which is another, if you just check Fred, you Google this, I mean, most of you guys probably know how to find this, but Fred is, the coolest thing that the Federal Reserve has ever done. Is this cool data tool. Here, I'll show you the link to this article. Here's my article. There's a question here. If you guys have any questions, please use the chat. Let me sure everyone got that. Wait a second, I sent it to the wrong people, everyone. All right, here's this. And here is this is the yield curve. Anyway, the long and short of it is this, is it basically, this curve is extremely inverted. And what that means is that, the short-term rates have come up more than the long-term rates. Everyone knows it, but the basic point is you can only get really so inverted. And there's a certain point where if I'm picking up, 5% or something in 2-year notes, I am not going to settle for 3% in the 10-year. And so the basic point is that as the Fed raises, whether you like it or not, whether it makes sense or not, these long rates are going to go higher. So the point is that now we're at this point where there was some optimism the Fed was going to kind of pause, and now it's pushing back against this level. So I wanted to point that out because today with this auction an hour ago, it kind of really jumped out at us. So I wanted to mention that. So basically, what's interesting here, all right, let's look at this chart, which is basically similar to the chart I have in my article, but I added a Fibonacci retracement. We've talked a lot about Fibonacci retracements. We talked about how basically the move coming off the October lows to the December highs, we had an exact pretty much 50% retracement. We only closed under that level one day and came right back 50% there. Now let's look at the next move. Let's look from here to here, and then from here to here. Right there, 50% retracement. We held and bounced. Now let's go from here from this low to this high. Wait a second. No, it was, where was it? It was basically here to here. We went under the 50% retracement. There's this long tail. And if you look on like the hourly chart, you can see how we kind of went under it, came back, and then exploded higher. There have been multiple times that the 50% retracement has basically, and if you look from here to here, we basically came down 50% retracement, bounced, but now it's kind of losing that. So what's really interesting to me, the most interesting thing that's happened in the last couple of days is if you look at this big bullish this big candle we had right here, if you just look at the total size of this candle, we never held 50% of it. And that to me is telling us something. It's telling me that this kind of like active move that we've had this calendar year is, at risk. And I think it's important to realize that there are a lot of things that you can look toward being positive, but we also have some unusual sort of things to think about with the calendar that I'm going to be kind of talking about here. So I think it's kind of important to see here that this trick, the 50% retracement, has worked like a charm all year. In fact, it even worked before that, because if you look, like I said, this was in, it started in Q1 when we held and made a higher quarterly low versus Q4, Q1, nice basing pattern. Everything worked with 50% retracements until yesterday. And that to me is something. Okay, so let's take a look now at my article. Actually look at some of the points. If you guys look at the article I just showed you, I'm not going to show it. You can just walk your way through it. We're going to start at the top part here. And this is basically when I look at the S&P 500. All right, let's look back here to this point. I remember this day well because I actually sold here and I was really happy, and then I bought again too soon and I lost most of my gains. It was frustrating, but I remember this day well. I think this was Jerome Powell. It was either a bearish. I think it was a bad. This was the last. This was a bad inflation report, and this one was the last bad inflation report. But the thing is, this was a bad inflation report. We knifed down, total jack higher, and then boom. This level is now, like, I think, pretty important. And if you look at the NASDAQ, it's even more important. If you look at the NASDAQ here, NDX.X, you can see this level. We closed over it really one day in the most feeble way, and we've been struggling at it since. So basically, this is to me a level that we need to be aware of. I've just noticed when you get these kind of moves, I call this a stairway to nowhere. It's like it climbs up and it gaps lower. It's a very ugly reversal. And this kind of pattern, people, this is just a pretty, kind of ugly reversal pattern. Now this was back here. So, I mean, granted, after this is bearish. The key thing is this is now just a level where this is actually, I think, some resistance if you really want to think about that. It's also interesting that back in early June, there are some levels here on the chart all the way back here to like February of last year. You can kind of see that, this is there's something here on the chart in terms of a zone that makes sense as resistance. So another thing I want to show you, quickly go to your MT breadth chart, and you'll notice this shows the number of companies, this special index down here. When the blue line goes above the red line, it tends to be an interesting, bullish signal. We had it on January 5th, but we crossed back below about, what was it? More than about a week ago at this point. So what this means is the number of S&P companies above the 20-day versus the number above the 50-day is red. So when it crosses above, it means more companies have bullish short-term momentum and vice versa to the downside. So what this is telling us is it, well, anyway, these crosses tend to be significant and they tend to be interesting signals. And we had a bearish one a week ago. All right, that's the next point. So that is on your MT breadth chart. I didn't add it because it's just, these things get too crowded. All right, fewer index member. All right. The RSI oscillator went to almost an overbought condition, and now it's coming down off the overbought. All right, I mentioned the retracement. I'm on the first section part, sizing up the S&P 500. All right, now let's go back to quickly the trading view because it's easier to see DXY, dollar index. Look at the weekly. Huge outside candle. Now something else, Fibonacci retracement on here. This is the 50% retracement. So this was last year, the big monster rally in the dollar. We retraced half of it, and now we have a bullish outside candle. So I'm not saying the dollar is going to go straight up. What I'm saying is this weak dollar move that we've seen this year, there's a lot of reasons right now to at least look for a pause. I mentioned the bond yields moving higher. Now, I think something else is important to realize is I always try to look at the calendar. There's this saying in trading, we all probably know it, buy the rumor, sell the news. So I try and ask, what's the rumor and when is the news coming? Now, it can also be sell the rumor, buy the news, depending on what your overall positioning is. But let's actually think about this now. The rumor is that the Fed is going to pause. The rumor is that inflation is coming down. These things might pan out. But now the problem is they're priced in. The other thing is that when do we get confirmation of them? The first thing we get is on Valentine's Day with CPI. So if we've already priced in less inflation, what does that suggest? Could mean that when we actually get the news, we sell it. Okay, that's a risk. That CPI report is enough time away that people might not let the market sit up here. So I think that's just something to think about. Then the other thing is you have to go all the way now to March 22nd before we really get confirmation the Fed is going to pause. That's when they do the next dot plot. That's a long time. So from my perspective here, the ability of this market to make new highs in the next 2 to 3 to 4 weeks might be limited. And like I said, the reason why is the fact that there's not a lot happening on the calendar. And the real stuff that really is going to matter will probably be the jobs report that we get on March 10th. And, there are people saying that we're going to see actually significant downward revisions to January because we had that huge number. Who was it? I can't remember which firm. One of these, Morgan Stanley, I think, said that there was something with a teacher strike, something in California where there was like a zillion people who were on work or off work or something, and it messed up the numbers. So anyway, the point is that we could see a big downward revision in that jobs report, which would not be a bad thing for the stock market. But the other thing is we get CPI on the 14th of this month. I think it's the 14th of March as well. I'm not sure. But we have basically 2 more CPIs and a payroll, and Powell will almost certainly be in Congress at the end of the month. I keep looking for the date and I can't find it. Senate Banking Committee, I can't find it. So the point is, the news that matters is gonna probably be in early March. And We're not there yet. So we have this dead chunk of time in front of us. That to me is just something to think about. And so that's one thing there to think about. All right, now let's take a look at this indicator I've shared with you guys. I showed you RSI. There's another one that I gave you in the second indicator called MA streak chart. It's basically what it does is it counts the number of days that, in this case, the 10-day moving average is rising or falling. I set it with the 10-day simple, which is my yellow line. I've noticed, now this is an indicator that I created. I've never seen anyone else use it, but it's inspired by similar concepts, which is that basically, instead of looking simply at magnitude of price, it goes to levels. I mean, levels obviously matter, but the thing is, instead of just looking at levels, we can also look at time. How long has the market been rising? Sometimes you simply need to do your time. And what's interesting here is this period of time, which is now 24 candles, is a pretty long time by most historical standards. If you zoom this thing out, and we do have longer periods if we really look, but you can see this is like when it's falling, it's red, right? So what this basically shows you is right now, this price streak that we're in is, competing, not the longest, but it's relatively extended. Now, the other thing I've noticed, and I just this to be a kind of rough analytical tool, but I've just noticed that very often when the index goes up and it touches the 10-day moving average like this a couple of times, it's usually the end of the upside. I mean, it's not always super clear on some of these, but like, I don't know, I haven't seen it as much recently, but I've often noticed that when the market like see these kind of moves, it goes up, it just kind of touches it. So very often, this is how it behaves with the 10-day simple. It comes up, it kind of touches it, sits, and then it dies. So anyway, that is what I'm looking at here. So here we are, we touched it, and then we're touching it again. We shouldn't be touching it so quickly. See here, we went down, we shot above it, we came back and we closed above it, and then we stayed above it, and now we touch it and we don't make a new high. What's interesting here is this is a relative, if you look at this uptrend, look, this is what, 1, 2, 3, 3 candles with a new high. 1, 2, 3 candles with a new high. 1, 2, 3, 4, 5 candles without a new high. That's interesting. All right, it tells us something. So I just want to point that out. The other thing is outside candle. I don't care if it's a bullish outside candle. An outside candle is a potential reversal pattern. Then we had a bearish inside candle. This is not a happy pattern. We went up today and we look at this. We basically went, our high today was 41.5685. That was yesterday. 56.85, today 56.23. 0.6 points under. And then we just died. So I wanted to just tell it. So from my perspective here, I'm looking at this. Let's just do our Fibonacci again. And we'll go to our Fibonacci price retracement lines. Let's just say that we need to retrace half of this year. Now, I'm not saying that, but let's say that that might be a reasonable expectation. So we go to the end of last year, we go to the high. Where does it put us? Let's just say that that's a level. And if you look at the actual chart in the article that I shared in this post, this blog post, this thing in this blog post, look, I have alerts going off because the VIX is going up. This blog post. All right. Go back to this chart. Look at this level. All right. 50% retracement right there. Look at the high of January 17 and 18. And then the low of the 31st and the 30th. Or the 30th, right? Look at that. Boom. So, right there. 50% retracement. Let's see. That's the line that kind of popped up when I did my my stuff in the chart. Looking at it, we have some time going here. I want to just say that there's really not a very bearish case right now. Let's not be bearish here in any really big way. I mean, the fact is that as we take a look out, there are things here that are very positive. It's just that they're going to take time to play out. So let's look at some of these issues. So I showed you the dollar. Let's go back to this. So it's interesting to me today that well, this last week, Jerome Powell with his thing at the Economic Club. He basically, he has been incrementally less hawkish, and I think it's important. Fed policy is like a pendulum. And then, like I keep emphasizing, we have a lot of space on the calendar before March 22nd. That to me is an issue to think about. Lisa Cook is a new member of the Fed. She basically was pretty dovish. She said we don't need to crank up unemployment. John Williams was a little bit more hawkish. He was talking about probably March, and what would be after that? Is it June? But basically, he's looking at March and May or whatever the next Fed meeting would be. But he's looking at another 50 in total. Chris Waller was more hawkish, and there was another guy today who is an alternate voter, Harker. I think it was Harker. Barkin, Thomas Barkin. He was kind of hawkish today. But anyway, like I said, the Fed right now is interesting to me because what I kind of think is they're gonna talk loudly and carry a small stick. It's like the opposite of Theodore Roosevelt said. They're talking a tough talk, but then they're basically going to be increasing at a slower pace as time goes on. I think that's interesting because there's two articles I saw this week that interested me. Both of them, well, one was on CNBC, and it said that wholesale egg prices are crashing. So interesting, we had egg prices through the roof. Those are coming down. That's obviously something positive for inflation. Pepsi also said in their earnings call today they're not going to raise prices anymore. So that's kind of interesting. So I think that's just something else to think about. Another thing that was popping up to me actually want to mention is that there's let me jump back up to this spot about the S&P 500. I just keep finding these things. I just saw this now, but basically there was a report from Deutsche Bank and JP Morgan that said that they expect that there was a $300 billion short covering. Now we saw this from Goldman Sachs previously, but it's finished, and now investors are going from kind of net bearish to more net neutral, but it's not yet clear they're going to go net bullish. So no, what's interesting is exactly what I'm saying, which is that essentially a lot of bad stuff is over, and I think people can look out and see that things are improving inflation wise and nearing the end of the cycle, but again, not there yet. So people are going from being really depressed to being moderately, middle of the road. And then the question is, if we get more confirmation, then we'll get more bullish as time goes on. I think that's where we are right now. We're in this kind of spot where we're building the bullish case, but it's not finished yet. Okay. So now I do want to show you something else to me. Well, let me first just show you this, and I'm going to show you this other economic thing. We had this huge payroll number last week. But what's interesting to me is that really what matters really is the wage growth is not spiraling out of control. That to me is the most important thing. I continue to say that I do not believe this link that wages drives up. I mean, this to me ridiculous. I know that the thing that drove up the price of most services was gasoline going through the roof. I mean, you have to be a genius to figure that one out. Most services with transportation and everything else, airfare, all that was fueled by the spike in oil prices last year. I don't believe that I don't think that there's any link between wages and inflation in terms of it driving it. If anything, wages follow inflation, but not the other way around. So I think the Fed is just wrong about that. And I'm kind of surprised to see that it has had such a powerful sort of belief. Anyway, I mean, you can see a little bit because we did have something of a excess pay during the pandemic, but in many ways, they were throwing money at people left and right. A bunch of companies, I remember Target did all these wage rises and stuff like that. So you can see that to a certain extent, but I don't think that's what has caused any of this inflation. To me, it's fairly obvious. The one word is oil, and that's really what matters. Anyway, I mentioned this about Morgan Stanley. What's interesting also is that we're just continuing to see on the services side, price growth easing, as unemployment goes down. So it just shows that this connection is not really the case. I mentioned this thing here about egg prices. So that was just kind of interesting. Now I want to show you something else. Also, this is the actual consumer price index. If you go to if you Google Fred CPI, you can find this. This is the underlying index. It's in and of itself, it doesn't matter. All that matters, it's like the S&P 500. As time goes on, it resets, and then you look at where it is relative to itself. So let's zoom into the more recent time. You can see coming out of COVID, boom, goes flying higher. Now, what's really interesting is this peak was June of last year. Now, if you do a little math, look right here at this number, 298, and then hover here, you got like basically 295. We're only like 1% up from June, and you can see how little we've gone higher. So what's interesting here is when we get to June of this year, if we just flatline, CPI is going to start, the year-over-year increase is going to go down really fast, because each time if you have basically a numerator and a denominator, and right now the denominator is big, and as time goes on, what's going to happen is the difference between those two is, the denominator is small, because right now we're looking at December 2022 against December of 2021. So that this denominator is going to be basically a bigger number, a smaller number, which means that the overall value of our fraction is higher. But as time goes on and the numerator on top of your fraction stays the same and your denominator goes up, your base, then suddenly the value of your percentage change starts knifing lower. And that's what's going to happen in the spring. So the thing is right now, if things just stay where they are, and there's a lot of indications that they will, with oil not doing too much to the upside and everything else, if things just stay where they are, inflation is going to start falling. And I think that's the thing right now. Everyone knows it's coming, and the market can price in things before they happen. But I don't think we can price stuff in 4 to 5 months before it happens. Not when there is a debt ceiling, not when there's multiple data points, not when there are other things that can happen. That's a long time to run up the market. So that's my point right now. I'm kind of thinking here, let's see what happens when we get to March, because at March, the Fed is, at March, first of all, we're going to be closer to this point, this June level. That's going to be closer to June, and we will have more clarity from the Fed. So from my perspective here, we're at a spot where there's a lot of underlying positivity, but it's not actionable yet. And I think that's what we need to kind of think about as we move throughout this calendar year. All right. I want to mention one other thing that was interesting to me is that when you look at some of the strength recently in the market, we've kind of seen a little bit of what you might call a dash for trash, with some of the more speculative stuff jumping more recently. And that to me is also like a little bit of that's often the sign that a bullish phase is ending. When you look at some of the more speculative tech stuff, jumping, that can be a kind of sign of the dying of the move. Another way to think about it is, if we look at a level like this, I pointed out, think of like boom, 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 like something like an ABC correction, a pullback, a bounce, and a continuation lower. A, B, C. That you can draw that easily on TradingView. And go here, and I can go to my little, somewhere here I have my patterns. I have an ABC correction like this, and you go like, A, like boom, 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 something like that. That's how people would, can draw things like that. And that's often the way things pull back like this. You can see that here. It's not always exact, but the key thing is that the first bounce when something starts going lower is often not the end of the pullback. It often goes lower. So I just want to point that out. If we actually were to look for this to go, maybe, that's the same level. Wait a second. Actually. Yeah, basically right up there. That's the same 50% return. I have a different fib line on there. Anyway, let's look at more stuff on our rundown. So again, the thing about Apple, what's interesting here is let's now go to our MT main chart. And, Apple basically, it was like the economic data. It was like, well, we have reasons to be optimistic. There are signs that of the big growth stocks, Apple still has the healthiest growth story. I mean, the growth story for Amazon, not hot, not very good, really. The growth story for Alphabet, not great. Advertising overall, just that entire sort of thing, not great. Even something like Meta at this point, not, this digital online advertising business. There's really no, really positive things about it. It looks to me like it's a secular, like it has peaked on a secular basis. And I think that is a problem for these big companies, and it's going to remain a problem. And that's the reason why I'm kind of thinking that as the market evolves going into the balance of this year, that the semiconductors, there's a lot of interesting things about semiconductors, but the big technology names will simply kind of fade, and you're going to see the financials and industrials fill that gap, and probably home builders and things like that as the economy shifts and as the leadership shifts. So that's part of my thesis. But anyway, the thing here I think is important is that, again, earnings revenue miss. They could blame it on one-off items. People were willing to be optimistic at first. Yay, that's great. And now here we are, basically, drifting out in space here saying, what next? It's like Meta. It's like, okay, what next? And this now becomes problematic in terms of continuation to the upside, and just kind of looking at it as the momentum fades. This is a sort of thing that the bears could start kind of piling into. Speaking of that, I did want to mention over in TradingView, we also do publish these ideas, and we did this is a candlestick pattern called an abandoned baby, and we did it on Amazon. You can see Amazon rallied up to the 200-day before earnings missed, and now we have this, kind of trend line that it's pushing against. So I wanted to point this out. There's, you can check this out on TradingView. Actually, another thing I should quickly mention on TradingView, if you go in my blog post and you actually click through, we also have this to the S&P, to the NASDAQ. We break down some of these same patterns. So it was at basically 12,753 when we did this. It's now down, about 300 points from that level. And wanted to just kind of point this one out because we have it. We did this basically a week ago. I wanted to share that with you guys. All right. All right, let me see. Let me see if there are any questions before I go on. How do I download the workspace? All right, let me see. I've already downloaded a zip file. It has no workspace called Market Breadth blog. All right, no, it does not have that one. I apologize. This one, wait, what it has is, all right, so just so you see this. This one I didn't share with you guys. This is one I keep just using to create my chart. This chart, I'm basically, as time goes on, I'm adding in indicators and stuff to it. And it keeps changing, which is why I'm not sharing it with you guys. These other ones, MT main, MT breadth, I never change these. So you guys can look at these, and whatever I have will be the same thing that you've downloaded unless you change it. So MT breadth was the one I was looking at. I apologize, that was unclear. Now I did give you, if you go up here, this is the link, this thing where it says here will give you this indicator that I was referencing, this price streak. Just make sure it's set to the 10-day. RSI you already have built in the TradeStation. So hopefully that helps you guys. Sorry, I will tell you one thing about TradeStation, everything comes with, The smallest drawback is that sometimes it's hard to kind of, you build all this stuff and then it's, I just find it hard to keep track of everything. So, I apologize if there's ever any confusion about stuff. All right. Let me continue now. There has been an interesting thing in travel stocks. Things like Uber, RCL, I'm sorry, RCL. Wait a second. All right, Uber had a good earnings report. I mean, this is kind of a hanging man. So, I mean, in and of itself, you know, Expedia, a lot of these guys have run a lot. And, just to beware of that. But it is interesting that Hertz had a good one as well. And Car started moving on that. There's a lot of travel stocks here that are interesting, and some of the airlines have been trying to kind of, they've been hanging in there as well. They had some big moves, American Airlines, DAL earlier in the year. And at this point in time, they're kind of sitting, but this is an interesting area to look at. The valuations on these are actually getting at a point where they're improving a lot as earnings go on. When you see companies just crush estimates and raise massive, the numbers from AAL last time just completely destroyed consensus. It just shows that people are not bullish enough on them. And people are not optimistic enough. And I think it's going to be interesting to watch things like the airlines and the travel stocks. We've seen some really strong flows of money into into these companies like Expedia and the airlines starting the year. And they are now kind of pausing and consolidating, not saying that they're going to keep going straight up from here, but we saw some real flows of money into them as the year began. And that might be something that we want to watch to see if this is a new trend. I will mention that it is the absolute opposite of what we've seen with a name like Procter and Gamble, which we also did a bearish trading view idea on. Let me actually put this back to my S&P over here. Look, you can see this on the MT main chart. If I put on PG, a lot of ugly things happening on this chart. Failing under the 200-day moving average. It's a bear flag here. Right now, I think honestly, the consumer staple stocks have so many problems. The underlying, I mean, maybe I'm the only one, but you go to Walmart, you walk down the aisle where it has like potato chips or something, and it's like I see not like Pringles or whatever it is, the Frito-Lay fully in stock. Then you go to where they have like the great value chips, gone. You look at anything like that when you go to Walmart now, and I don't go to Costco, but these guys right now, and what did they say? Volumes. That was the word. Bad volumes. They can raise prices and people kind of put up with it for a while. But the fact is that people are not buying their stuff, and they are losing market share to knockoffs and whatever they're losing to. These consumer staple stocks look really ugly. And when you look at their balance sheets, they have a fair bit of debt. The market always said, well, we'll look past debt if you are a marquee brand. But you know what? Maybe they're not marquee brands the way they used to be. I remember there used to be a company called Gannett that used to own USA Today. I mean, that was like the greatest thing in the world. And what happened to USA Today? I don't even know if it exists anymore. And, that is what's kind of starting to happen to some of these consumer product companies. So it's very interesting. Last year, a lot of them had a lot of strength late in the year, and they just came unglued in late December. GIS we're looking at, Kellogg. I mean, this to me is kind of interesting because, as inflation happens and one of the places where people kind of cut back is on these sort of overpriced consumer goods. Or I don't want to say they're overpriced, but people say, you know what, I don't really need to buy that, $2 bottle of soda or whatever. And when they're paying more for other products. So it's happening to these companies. And I think it's important to kind of realize that. And I did that thing in Procter and Gamble. But I wanted to just mention that because, this area has a lot of overall weakness. It's interesting also that there is an interesting thing happening in the cybersecurity. It's like a kind of under the radar Fortinet and Tenable. FTNT was a real outperformer for a while. I mean, this stock has been, I mean, pretty incredible. I mean, I just want to point this out. This is an interesting uptrend. Long term, it's had a long sort of consolidation, and now there's some things coming back. And here we had the 50-day moving average coming up. So this might be interesting to see what happens if it gets back into the under 55 to see if people might start to get interested again. And the other one was TE. It's just interesting to me, TENB. The thing I thought was interesting about this was, it's government spending. It's not, as competitive. It seems like some of these guys have a pretty, clear spot. Some of these other software names were more kind of vague in terms of what distinguishes them. Another one that was just interesting, I mean, this company called Freshworks, FRSH. I mean, again, I'm not really sure much about some of these, but I'm going to get to something in a minute. What's interesting is this company had an IPO basically at the peak of the kind of COVID QE growth bubble. And it's down more than half since then. Actually, it went public, I think, at 36, went all the way to 50, and now it's like $17. But it's interesting because their numbers were decent. And a lot of these companies have pulled back a lot. And I'm going to show you something in a minute about, looking at these, because a lot of these stocks now, they have pulled back for such a long time that they could actually be at a point when they start to get some interest. IPO stocks can be interesting after about 18 months because they start getting added to indexes, and most of the sort of weird stuff with lockup periods and all that stuff ends. It's not to say that it totally does, but generally as time goes on, the oddities of their offerings fade and you start getting more, real fundamental appreciation of the companies. There's this interesting sort of stuff that there's a bunch of bullish notes coming out on it. So again, the analyst starts to step in and, this has been going sideways for, 10 months here. So I'm not saying I'm bullish on it or recommending it. I'm just saying that if these companies are starting to have some fundamental things that are positive, we're at a point now when people are going to start to pay attention to those real things. It's interesting also, we had a golden cross here, the 50-day above the 200-day on this one. I wonder if Apple can say, nope, Apple doesn't have a golden cross. The NASDAQ doesn't have a golden cross, but Freshworks does. Isn't that interesting? Okay. All right. We also had, what's interesting also is we're seeing a lot of companies that are able to kind of play the buyback game. And this is more of an interesting story now. A few companies, by, increasing their payments to shareholders, they are, boosting the stock. And, it's interesting because for a long time, we did not see this as a real sort of narrative. Now, I will mention that in my previous master classes, I would talk a lot about, I called my 7 catalysts for stock movement. And right now, I don't actually have I have to re-update those old stories and give them back to you guys. But the idea was there's basically 7 reasons why any stock moves. And I believe this is true 95% of the time. The number one thing is volumes. You're selling more stuff. Essentially, when you're selling more stuff, most things are going to go in your favor most of the time. If you sell more stuff, you get economies of scale. It implies there's demand, and there's growth, right? The other thing is margins. But then you also have these things called strategic actions. And that's when you don't do anything to change the business itself. You just kind of like change the corporate or the financial structure. So it's kind of like you own a house, it's $1 million house, and you might own it in cash, or you might have a $500,000 mortgage, or you might have an $800,000 mortgage. It's all the same house, but the performance of the house as an asset will vary dramatically based on your leverage. So if you have a business just out there like Skyworks or something, the business is what it is. But then if you buy back stock, what it does is it actually, that is a strategic action. So what's interesting here is there's a lot of strategic actions. There's M&A, like this company exploring a sale. There's M&A, buybacks and dividends. And I've been saying this for a while now. We were in a market that was so dominated by growth and low interest rates that people forgot about M&A They forgot about buybacks and spinoffs and activist shareholders, like we're now seeing with Disney. This, in my view, is likely to be more of a catalyst going forward. We're not going to be in as much of this sort of QE, hyper growth market. We're going to be seeing the kind of nuts and bolts of capitalism going back to work. Another company just kind of interested me was this one, Voya Financial. I don't know very much about it, but they had some interesting things happening, and they also have significant short interest. So I'm just kind of watching this one. It's I don't know. It's kind of interesting. At the time we did this, if you look here at our, all this stuff I essentially get from the key ETFs, and I basically look at performance of things. And what is interesting is growth versus value. You can see here that after we spoke, you can see the growth stocks. And I said last week, if you actually look, I was saying that it was extending, the growth was extending its lead, and that did happen. Will it continue? I'm not so sure, but we have seen that kind of continue. As I kind of look here, to me, there's not a lot of really clear, at this moment, we do see some real strength in the semiconductors that continue to outperform. But actually, I should mention, this morning I really wanted to short the gold miners, and I was too busy. But look at this. Oh my, this is a gnarly. All right, I should actually mention this. I mean, what did I say about the dollar? The dollar ripping, interest rates going higher. And I'll tell you, there were a lot of people, I've listened to guys like, oh, gold's going to 3,000. And it's like, nice try. And I'm this is, to me, a lot of risk, I think, now with the dollar. Because the thing is what happens if inflation goes away? I mean, what is the point of owning gold? I'm sorry if some of you guys are gold bugs. I know for some people it's a very emotional thing, but the fact is that this gold is just not, anyway, to me, you just got to be careful of. And if you look at this on a long-term thing of the GDX, but I want to just point this out. This was a big outperformer coming out of November, and we're seeing a lot of signs here of this thing breaking lower. I did want to mention that. What's also interesting here is we have this cross of the 8-day exponential moving average below the 21-day right there. And actually, if you look here at some of these things, I think I have it on MA tools. So let's look at MA tools. A little trick I'll show you. We have this crossover. All right, this thing. How did I get this? All right. So I can talk all day about this stuff. Every morning I try and look at these and look for things on these ETFs to get a sense of what's happening. Let me go over here to MA tools and show you this little trick. I'm going to erase all this, and I'm just going to put in my ETFs. So this shows me recent crossovers of the 8-day below the 21-day. And look at GDX, just happened. Chinese tech stocks just happened. So it highlights it when it happens, either bullish or bearish anyway. So to me, this thing was up more than 1% in the pre-market, and the bearish cross had just happened. And I remember just looking at it and saying, man, this looks bearish to me. It's just kind of interesting though, because with that bullish outside weekly on the dollar, and the Fed, kind of not being overly hawkish, but also not, saying we're done with rate hikes. This narrative we've seen in GDX and the gold miners is coming unglued. And it's also interesting with bond yields moving higher, and honestly, with inflation coming down. I mean, it just doesn't make a lot of sense. Can I create a study of a radar screen that lists the actual weighted percentage? It does not exist that I'm aware of. But if you go to SPDR, the SSGA, I think is their website, the spiders, and you can download the holdings of SPY and you can get the weightings, but I don't have that data. Is not, to my knowledge, available in the data set. All right. I want to just mention that the thing we're seeing a weakening here in the global trade and things like that. And honestly, look at some of these software stocks, the growth stocks with interest rates and the bond yields moving higher and stuff like that. It is going to be a kind of a tricky going to be a tricky proposition to see if that continues. Right now, like I said, I think, if we are kind of at the end of this upward thrust, then leadership is not hugely important. What's kind of important is, if we get a pullback, let it settle. These are some signals that popped up on my chart. Occidental, I think it's just there's so much money stuck in this. It seems like everyone was buying this, but now it's like a death cross. I want to just kind of point this out, which is kind of interesting. CVX had, also failed breakout. Let's see what happens with this here. These energy names, I've been waiting and watching to see what happens with energy. I've seldom seen things as confusing as energy is now. I really don't know what to think of it because there's so many reasons to be positive about it. And a lot of it's simply not coming together. And I just don't know what to make of energy here. But I'm watching them. I did notice interesting, LNG is also looking pretty bearish here. Breaking, kind of trapped at that 200-day. This was a big leader, the whole thing of Europe buying American natural gas. And, here it is just kind of stuck breaking under the 200-day with the 50-day coming down, death cross potentially in the future. This one was an interesting one, LQK. Again, technically a consumer discretionary because auto-related things are. But this one popped up yesterday when I was preparing my notes because it hit the 50-day moving average. Now, if you don't know how to find that, go back to MA Tools, erase this, bring in the S&P 500, and this basically, it'll show you stocks MA test. It won't be here today, but it was yesterday. This shows companies that are touching the rising 50-day moving average. Today we have Halliburton, we have Hewlett Packard Enterprise. I don't know if there's anything hugely meaningful at this to me right now, but this one yesterday, even with the market down today, this thing, had a bounce. So this was a signal that came up yesterday. It was also the bottom of the Keltner channel, which are my white lines here. AT&T also yesterday was hitting the bottom of the Keltner channel. You can see that it tried to bounce. It's not holding, but it did try to bounce. So I did want to kind of point that one out, that a lot of these are indicators that you can access in different ways using my workspaces. These are just signals that pop up. I read this other one. It's kind of interesting. I'm not going to do this now, but if you go to Google Trends, you put in ChatGPT, and then you look at this stock AI. Basically, the two charts look the same. ChatGPT was trending upward, and this stock was shooting higher. I wanted to just point this out. I don't know what. Like I said, this is just like a fad. The bears are probably going to just hammer this thing back down. I think AI has a future. Does it mean that it's a trade or an investment? No, not really. Like I said, it's probably going to be like anti-lock brakes. When I was a kid, no cars had them, and now all cars have them. And there wasn't really probably many ways to invest in that trend. It just became a feature of an existing product. And I think this AI is going to essentially become. Anyway, I want to just point this one out. Very quiet week, like I said, pretty quiet into next week. All right, so the last thing I'm going to show you guys very quickly. If you go into, let me see if I have any questions. What about the files that go with each? All right, I did see a question. What about the files that go with each masterclass? So let me just tell you, technically this webinar I'm doing is not masterclass. It kind of is under that series, but this is market trends, and it will always be any materials from market trends will always be on Market Insights before I start the webinar. There will always be a blog post with a link. So that's where you can find all the materials, and it will always be in this article. All right. So one of those links that one of these things I gave you guys, if you actually go back to the zip file, in the first zip file, there's this thing called IPO tool. Okay. So let's put that very quickly. And I wish I had a little more time, but I'll just very quickly create a radar screen and go to, let me show you how to use this. Why is my, it's funny, this thing moved around because I created a new desktop. All right, let's put in some of these companies like AI, FRSH. Let's put in a company like Uber. What are some other companies that went public not that long ago? PLTR, DoorDash. Okay. Now let's change this to daily. And now let's put in, it's called exclamation point IPO tool. All right. So now what we want to do is we want to change this now to say, let's just change it to, we'll go to general and then go to additional bars to load. Let's change it to 600. I'm going to just show you how this works. So this is going to look for 600 bars of data, and oh, look at this, Freshworks. Let's just go very quickly to make this more visible. It only shows 348. So now let's look just for comparison at a stock like, Apple. 601. Remember, I loaded 600 days and we see 600 candles. Very simple code. All it does is it counts how many days of history. So if you load 500 days of history and it only can find 348, it means that this company went public 348 bars ago on the daily chart. So this is useful for finding IPOs because there's a lot of companies went public and we forget all about them. So let's just very quickly go to Scanner. And I actually think I have an existing scan on this. Let's see if I can find it. Sorry, I need to find a way to keep this more visible. All right. Anyway, I think I have something here called IPO, recent IPOs. All right. All right, this one's just called recent IPOs. I created this. So basically it looks for stocks that have the volume average of 10-day, but the key thing is the IPO tool is set to less than 500. So I brought this in as an indicator. So very quickly, let me just do a new scan. Let's just call it, IPOs. And then we'll go to, all stocks. And now what I want to do is go to indicator. I'm going to go IPO tool. And now we want to click on this thing and set this, see it defaults to 250. We want to set it to 500. All right. And if you look at the code of this, it's very simple. And then just set it to, of that list, let's say less than 470. Because Apple will come back at 500. Anything that's, older will be a 500. Will return 500 or 501. And then let's just hit run. And it's probably going to be kind of slow, but essentially what I'm looking for here is I'm looking for companies that went public in the last 2 years. And then some of those companies, as time goes on, they could be like Freshworks or some of these other names. They're going to get added to indexes. They're going to pick up more analyst coverage. And the other thing that's interesting is that a lot of these companies is that they just got completely hammered after their IPOs. They went straight down. And some of them are going to just keep going all the way to zero. But the thing is that some of them will stabilize and some of them will find real owners and they will become real companies. And this is the time to start looking for them. Some of those may be the companies that outperform for the rest of this year as the market, if the market does stabilize and push higher later in the year, some of those companies now might be setting up. And this basing period that we're seeing in equities, this might actually be the time when they start becoming real. And we never know, but one way to start is by using this tool that I just gave you, using Scanner. Boom. All right, so we have our list here. Let's just go here very quickly. Copy. Let's go over to MT main. Let's go to price grid. Let's just paste it into price grid. Let's price it into fundamentals. And let's see what we get, right? And put it into MA tools as well. But now we can very quickly start analyzing and seeing, oh, of these IPO stocks, we have some of them that are up. This one started to move in the last 2 weeks. We can now very quickly start looking through them. The fundamentals tab will tell us their sector. We can start looking at things like market cap, PE ratios, and start learning. The last thing I'm going to show you is, remember, if you're interested, go to studies, go to next earnings date if you want to see, and you can start tracking them into their next, boom. Now it's going to start downloading the earnings dates, and it'll start tracking them into those next earnings. So I'm running out of time. Great to talk to everyone. I will see you again next week. Don't forget, go to Market Insights and look for these blog posts. That's where I'm going to be sharing this stuff. I'll see you again next week.